Welcome back to the channel, to Daily Forex. So guys, on this video I'm going to show you another strategy on how you can catch spikes on boom 500 index market. Okay, now we're going to be using the stochastic oscillator. So right now I have the stochastic oscillator on my chart, so I'm going to show you the parameters and the setup for the stochastic oscillator. You put here to level 6, the period on 6, you change this one to 4, then you leave the slowing on theory. Okay, you leave slowing on theory. The price feed will be low/high. The method is going to be exponential. The levels is going to be 22, 80 and 64. Style on 4 pixels with the color of black. Then you apply it to all time frames. The main, you put it on 4 pixels. The signal, you put it on 4 pixels with the first trend line here. Then you should click on done. Okay guys, perfect. So we're going to be using just the stochastic oscillator, and I'm going to show you how you can catch spikes using this indicator. Okay, now you zoom out to the last zoom level. We're going to be using the 4th zoom. So you zoom in 4 times. You zoom into the 4th zoom level so that you can see the market charts clearly. Okay, now we are at the 4th zoom level on this market. Now how do you catch spike on this market and how do you avoid spikes? So they are mainly to the same process on how to catch spikes and how to avoid spikes. So if you are avoiding spike, probably you are selling the market and you don't want the spike to catch you, right? So once you place a sell on the market and you see a signal whereby the spike would come, that is an opportunity for you to exit the market so that the spike doesn't take away all your profit, right? Then if you want to catch the spikes, all you need to do is wait until the opportunity for that signal, then you place a buy for the spike on boom 500 index. So we are on the boom 500 index market right here, and if you want to catch the spikes, all you need to do is wait until this stochastic oscillator, this black line and this red line has crossed below this level of 22 here at the oversold. Okay, when it crosses below this level of 22, then you wait until you see a crossing between the red and the black line. So immediately there's a crossing giving you an upward trend going upwards. Immediately you see a crossing, immediately this red line touch this black line, the spike will come in. See, the next step is a spike. If you trace it upwards right here, you can see that here is a spike on the market. After the crossing here again another spike on the market. So imagine that you place a sell at this point right here, and the stochastic oscillator indicator, the trend lines touch each other at the right side. It needs to be at the right side. Okay, at the right side. When they have touched each other, know that the spike will come into this market. Okay, so you can use this strategy and the stochastic oscillator indicator to avoid spike on the market. And remember that even though you are at the overbought region, it still works as well. Okay, when they touch each other, now if you can see that this level here is not the level of 22. So at the overbought level, if the spike would come in, you know that it's going to be a small amount of spike on the market, probably about 10 candlesticks away from that spike. So you see at this point right here, this is at the overbought here, at the overbought region towards the upward side, and the spike that came into the market wasn't that huge enough. Okay, the spike that came into the market wasn't that really huge, but you saw that at this point right here, when the red line crosses above the black line, the spike came into the market. If you want to be on the safer side on the market, all you need to do is to wait until this black line has gotten below the level of 20. Okay, so probably you'll be taking about 4 candlesticks or 5 candlesticks from the market before the spike comes in. So you can wait until price has gotten to this level of 22 here at this point. When it has crossed below this level of 22, you have gotten about 5 candlesticks, then you exit the market because spike will come into the market. Because once this line here go upwards, curve upwards, the spike will come into the market, right? Take a look at that. The spike will come into the market. Immediately it curves upwards. See, look at this shape right here. like a V shape. So immediately there is a curving upward. So all you need to do is just wait. After it has gotten below this level of 20 right here, you exit the market. Then if you want to place a buy for a spike, then you wait for that same opportunity. When it has crossed below the level of 22, then you place a buy, waiting for that spike to come into the market. Right now, remember that if you place a buy, the market will be selling, so you'll be in a disadvantage at first. So what you need to do is calculate the amount of lot size you are going to use for that trade entry. Okay, you calculate the amount of lot size you are going to use for that trade entry, so that your profits will be more than the losses on the market. So don't just jump in quickly. Always enter into the market at that good and perfect opportunity. Okay, at that good and perfect opportunity. So I hope you understand what I just said to you guys. Now take a look at this point as well. This strategy also works very perfect. Now there might be an instance whereby even after this line of the stochastic oscillator, which is this red line, and the black line has gotten below this level of 22, the market can still continue to sell. But you can see that even though you have placed a sell at this point, from here downwards to this point here, you would have gotten up to 6 candlesticks as profits from the market. Okay, you don't need to be greedy on the market. You don't need to stay on the market for too long. All you need is to wait for that perfect opportunity. Then you take that opportunity, your profit, and you exit the market. Okay, so if you decide to stay long on the market, there might be a loss on that market. Now at this point right here, the market spiked, then the market continued to sell a little bit. Now I want you to take note of something about boom 500 index. Take a look. There was a spike here and there was another spike. So it is not possible by any means or by any chance that this market would spike again. Okay, it is not possible, because if you zoom out a little bit at this point right here, you can see that the market has bought up to this point and it sold. Yeah, you can see the market continue this trend lines going upwards. So it cannot just, after it bought up to this point, it bought again, then it bought again. No. Okay, it has to retest, giving you about 5 or 10 candlesticks then before it go upwards. Okay, so now that is your opportunity. So when you see an opportunity like this on the market, after it has bought, then it bought second time, then you enter into the market, take 5 candlesticks, then you exit from the market. Okay, I hope you understand what I've just said to you guys in this video. Okay, now if you found value in this video that I just shared with you, do it to like and subscribe to the channel, the Daily Forex, for more awesome trading tips and strategies. All right, and also join our Telegram community. The link is going to be on the description of this video. On our Telegram community, we trade together and we share tips and strategies on how to trade the forex market, boom and crash market, volatility 7 to 5, and other type of indices like stepping index as well. Okay, so I will see you guys on the next video.